Welcome back, everybody. Well, the market seems to be super volatile just about every single day, with it going down about 10% over 3 days and then up about 10% in one day, and now back down 3, 4, 5% on the next day. I mean, what is going on out there, right? Now, obviously, there's been a lot of financial and political news that has driven the narrative in the markets, and we just talked about it in my last video, which we're not going to rehash all that type of stuff, but I did want to show you one indicator that I tend to look at just to get an idea of where the market's at any given time. And that indicator is simply something that people call the VIX. Now, the VIX is the S&P 500 Volatility Index. And you might be like, hey, that sounds like exactly what we need right now. And I'll show you how whenever the VIX is around where it is right now, it usually means it's a really good time to buy. And I'll show you why I think that is, and again, why I think most of the time narrative follows price. Now, if you don't know what the VIX is, it's basically the CBOE Volatility Index, and it's a real-time index that represents the market's expectations for the relative strength of near-term price changes of the S&P 500 index. Now, that's a lot of words, and you're like, what the heck does any of that mean? Well, we're going to dig into it right now. It's derived from prices of the S&P 500 index options with near-term expiration dates, so it generates a 30-day forward projection of volatility. And it's kind of similar to the Fear and Greed Index, which I'm sure you guys see online a lot. And I actually think that the VIX is part of how they calculate the Fear and Greed Index itself. But the cool thing about the VIX is that it actually has its own index that you can chart and see kind of where it is over time. And so we're just here in TradingView, and this is my chart for the actual VIX, which is right here, the Volatility S&P 500 Index. Now, you might see these two green lines here, and don't overreact to what those green lines are, but in general, what people say is that when the VIX gets to be under 20, then that's about time to sell, and then when it's over 30, 35 or so, then that would be time to buy. Now, again, don't overreact to what these numbers are. If you've watched this channel for a while, you know that I don't believe in hard and fast rules to where, oh, if it hits this number, you always buy, you always sell. And I've told you guys many times, I focus mostly on fundamentals. But what I like about technical factors is that they do help to explain kind of the noise in the market a little bit better, because that's when people are like, hey, why is the market going down? All my fundamentals are strong. And it's because the market isn't made up of just fundamentals, right? You have investors who are traders who only work on technical signals. You have whole hedge funds and other participants who only use technicals. So just because the fundamentals are strong doesn't mean it's going to act the way that you assume it's going to act. And that's where technicals can kind of give us a little bit of visibility into what the market's doing. And the main thing I want you to see here is that if we go to the VIX, basically since, let's say 2008, obviously we all know what happened in 2008. This was the great financial crisis, the mortgage crisis, right? And so the volatility was just insane, like off the charts, right? But let's go to where we're at today. Like today, the VIX is at 44, 45, right? And you can see that just a couple days ago when the market was down a bunch, it was closer to 60, which is just a really high number. And the way we can see that is if we look historically at the VIX and its peaks throughout time, I mean, this is basically 2008, you can see that it only reached 60 like it was earlier in the week a few times in the last 10 to 15 years. I mean, you had this time right here, which was ironically August of 2024. And if you guys remember, that was when the market like tanked and then recovered, pretty much within a week or two. Then obviously, if you go here, you see March 2020, which was obviously the COVID pandemic. And then it didn't actually hit that high of a level all the way until back in 2008, which of course was a great financial crisis. So what you see is that the volatility index, or the VIX, had only been as high as it had gotten this past week, just a few times over the past 10, 15 years. So what this led me to do is I wanted to actually look at each one of these spikes in the VIX and try to understand what exactly happened at that point in time. And look, a couple of those were pretty easy, right? 2008 was the financial crisis. 2020 was obviously COVID. And so some of those were obvious, but a few of them I'd kind of forgotten about. So what I did is I just went to Grok and started asking it questions like, what happened in February 2018 market crash? And it basically said, In February 2018, U.S. market experienced a sharp and sudden downturn, often referred to as the February 2018 market correction. And that is an amazingly descriptive name. But basically it said that the lead up to the drop, the market had been on a tear, the Dow hitting a record high. And then on February 2nd, the U.S. Labor Department released a jobs report showing that wages grew 2.9% year over year, the fastest pace since 2009. This sparked fears of rising inflation, which could prompt the Federal Reserve to hike interest rates faster than expected, cooling the economy and corporate profits. So if we go down to what caused it, it says inflation and rate fears, overvaluation of the stock market, algorithmic trading, and just in general market mechanics. So you can see for February 2018, that was kind of the news of the day that was inciting fear, driving volatility in the markets. But let's take a look at a few others. So if you remember back in August of 2024, if we ask Grok again, it's like, hey, the US stock market experienced a turbulent period marked by significant sell-off followed by a rapid recovery, and here's what happened. So in terms of what caused it, it said economic data, there was a weak jobs report, and rising unemployment sparked recession fears, while later data calmed nerves. Plus monetary policy shifts, the Bank of Japan's rate hike disrupted global markets, while Fed inaction followed by hints of easing drove volatility. Then also market dynamics, the unwinding of the yen carry trades and tech sector correction amplified the initial drop, and then investors then bought the dip with trading activity spiking 55% during the sell-off. All right, so then let's go to the next one, which was, 2020. And obviously for 2020, I think we all know what that one was. It was the COVID-19 scare, and obviously the markets just crashed and tanked and were like that for, a few months. I mean, basically February, March, and into April. But then it was a rapid recovery after that, which was driven by a lot of different things. There was a lot of stimulus and money into the economy, and those went into stocks. So then if we keep going, we see February 2018, which we already talked about, kind of started with the wage growth data and the market overvaluation. And then if we keep going, we see August 15 was another one. And then if we ask Grok about August 2015, they say that it was a sharp and sudden stock market sell-off, often dubbed the China crash or Black Monday 2015, driven by global fears over China's economic slowdown. So basically what caused it was China's economic growth was faltering, industrial output, exports, and commodity demand weakened. Their currency devaluation amplified fears that Beijing was losing control, threatening global trade and commodity-reliant economies. Then we also had our own U.S. Fed uncertainty around the time, where they were poised to raise rates for the first time since 2006. And of course, there was still overvaluation. After a 6-year bull run, U.S. stocks were pricey, with the S&P 500 PE near 20. And then if we just keep going, we see August, September, and October of 2011. And according to Grok, the period of August, September, and October 2011 saw a significant stock market downturn driven by a mix of U.S. debt ceiling drama, European sovereign debt fears, and global economic slowdown concerns. So in terms of what caused it, right, debt ceiling brinkmanship and S&P downgrade shattered confidence in U.S. fiscal stability, even though treasuries ironically rallied as a safe haven. There was a Eurozone crisis as Greece nears default, and contagion risk to larger economies like Italy threatened the euro's survival, dragging down global markets. And then overall economic weakness, where the post-2008 recovery stalled, U.S. unemployment stuck above 9%, Europe faced austerity fallout, and China's growth slowed. Okay, so you're probably like, all right, I get it. There's a bunch of stuff going on, but what's the point? And my point is that when you look at things like volatility, it can definitely be a tool to kind of help you understand when markets are in a pretty decent buying range, right? Now, it doesn't mean that you can predict exactly what the market's going to do, because that is never true, right? But if we just look at the chart, what you see is that anytime this VIX spikes up above 50 or 40 or whatever number you want to use, then it usually signals a little bit of a downtrend in the market. But ultimately, the VIX goes back down and the market recovers and starts going back up. And then again, you have a spike in the VIX and a little bit of downturn in the market, and then it continues to kind of go up. Now, these times here where the VIX is high for multiple months in a row usually correspond with a longer downturn. And a great example of this is actually 2022. After the COVID crash, it came all the way down to about 15, and then it started spiking back up as we got into 2022, and it just kind of kept staying there, hitting that 30, 35 mark pretty much for the first part of 2022, which is exactly what you see as the main downturn from the end of 2021 to about October of 2022. But basically, each of these spikes, including the 2020 COVID spike, to the August 24 spike, to the spike that we had just now, they all correspond to the market going down, but then ultimately recovering once the VIX kind of subsides. Okay, so what's my point in all this, right? You're like, yeah, no duh, markets go up and down. Yeah, sure, you can't predict anything. Yeah, sure, we've had crashes before. But the point that I'm trying to make with this is that if you look at every single one of those points in history, there was always a reason, right? There was a reason why the market did what it did. There was a reason why we had the market reaction, and eventually the market recovered. And so in my last video, when I said that I was cautiously optimistic, I know some of you got upset by that, but this is one of the reasons why. I mean, at the end of the day, yes, I don't have to agree with all the things that are going on. There's a lot of uncertainty in the market, and I've said many times on this channel that one thing the market doesn't like is uncertainty, and we definitely have a lot of that. But what gives me a little bit of hope is the fact that currently the volatility index is at a place where throughout history, at least the past 10 to 15 years, has ended up being a really good place to buy stocks, and they've recovered in a really nice way. Now, you could say that, well, the last 10 to 15 years were a little bit unique because after the great financial crisis, we had a bunch of stimulus injected into the economy. We had a bunch of 0% rates for, a decade, and that's why the market kept recovering. And there's a chance that that may not be the reality going forward, but when I look at those charts and I see the fact that, okay, we just hit a volatility index number that had only been hit a few times over the past 15 years, and every single one of those times represented a really great buying opportunity, to me, I'm going to kind of play the percentages and say that this past week has been a really good buying opportunity as well. Now, that doesn't mean that the market is just going to keep going up from now. I actually expect it to continue to be volatile for a while, and we may see one of those things like we did in 2022, where the volatility index kind of stays in this higher up range for a while as prices come down. Now, there's no way to know that for sure, right? And that's why I say we can never predict exactly what's going to happen, but at least we can get an idea to say, look, yes, is this unprecedented news? Maybe, but from a stock market perspective, we've been here before in previous times and we've always recovered. So the reason why I've been preaching for like 3 weeks now to just kind of work your plan, don't worry about all the noise, don't overreact to all the news, is because that's kind of what's been the pattern for how many decades now? Anytime we see this type of volatility, in my opinion, it's a time to really focus on, okay, what should I be buying right now? And not who can I argue with on the internet about how right I am about the state of the world. At least that's my own personal preference, because that's the one that leads to us building wealth for our families, and that's my primary goal. So while the daily market volatility does get a little bit scary, I will say that seeing how rare the volatility index is compared to the most recent history actually gives me a little bit more confidence that, you know what, regardless of how long this volatility lasts, I do think adding to great companies at these prices at this point in time is likely going to be something that bodes very well for investors who have the stomach to be able to do so. So if you're looking at the stocks you just bought this past week and seeing that the S&P is down another 4% today, I wouldn't really worry about it. I mean, again, this is one of those things where there's just so much noise nowadays when it comes to social media and news, and all the headlines are always like real dramatic and trying to get an emotional rise out of you. It's just time to kind of be calm, keep working your plan, like I've been saying for I don't know how long now. And I think when we come out of this and we come out of this volatility, what you're going to see is that it was a very good decision that you kind of kept your head and just kept adding to great companies that you really love. Because at some point we know that this volatility index, even if it keeps going up or kind of stays elevated for a while, is going to come back down. And that's when all the stocks that we bought that are really high quality are likely going to go up with the same amount of push and volatility that they went down with. So what do you guys think about the VIX? Is it a tool that you actually use when you're picking your stocks? Let me know down in the comments below. Now, if you want to watch my video that I just released talking about my thoughts on tariffs, America, and stocks overall, you can watch that by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom. So keep building and stacking wins, and I'll see you on the next one. Peace.